Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, once again, a best-selling author. His name is Robert Wiedemer, and you know him best for this book right here, The Aftershock Investor. It's a best-selling book. It's helping people, guide people through this post-crash. Came out in 2009. Robert Wiedemer, thank you so much for joining us today on USAWatchdog.com.
Well, thank you, Greg. It's good to be here.
Well, you know, I was at a conference, a Jim Sinclair conference, and listening to him talk, and he says a lot of the same things you do. Jim Sinclair is one of the most brilliant investment people in the world, one of the best gold guys in the world, just one of the best investment people in the world, and he's saying a lot of the same things you did. You came out in 2006 with a book that preceded The Aftershock Investor, America's Bubble Economy. Not quite a bestseller, but almost, but this came out in a time when, woohoo, in 2006, everybody was predicting the real estate market is going to go up, 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 up. Nothing's going to stop it. The stock market is fantastic. You and your brother, David Wiedemer, who has a PhD in economics, and also Cindy Spitzer, wrote this book in 2009. It's the Aftershock. But the preceding, you had that book. Now you have an updated version of the Aftershock Investor. And when I heard you had an updated version, I thought, well, you know, Robert Wiedemer is a smart guy. He's been right on the economy. I'm going to have him on. And I didn't realize, but, you know, even though these book covers look, you know, a lot, you know, look the same, even though they look the same, I mean, this new book, this fully updated version that it says here, fully updated second edition, is like a brand new book. And I love your you signed it for me. Thank you very much. Like you did the other one. And the very first chapter is talking about the recovery, which is, you know, there is no recovery. And is it a fake recovery? Better than no recovery? And this book is came out in last November. And this new book is talking about how, you know, don't believe everybody's telling you that gold's a risky investment. Don't believe anybody that the real estate market is all fixed and we're on our way back. It's still in a bubble. Let's start with the new material, which is like doing a whole new book interview. Let's talk about this fake recovery that you say the recovery is 100% fake.
So I use as an example of it being fake. If you look at the amount our economy has grown, I mean, even this year, I'll use a good example, or last year, 2013, our GDP grew, you know, a little over 2%, $350 billion. But we borrowed, our government borrowed over $700 billion. Well, that tells you right there that, yeah, that we're actually borrowing more than we're even growing. Our entire growth is due in part to government borrowing, and actually even more. So it's a fake recovery, and I often like to say it'd be great if we would adjust our economic figures that we come out with you know, for stimulus adjusted figures. What would they really look like if you took the stimulus away? You know, this fake money, borrowed money, which is supported heavily by a lot of printed money, almost $1 trillion last year, over $1 trillion last year. So we're not talking about that. We're not talking about what's driving what recovery we are getting, and that's that massive money printing and massive money borrowing. So that's what I mean by it's a fake recovery. Yes, we're getting some recoveries, but it's all driven by something that is not sustainable.
I mean, I said this in my weekly news wrap-up, and, you know, I mean, the current cash deficit, you know, Lawrence Kotlikoff and many, you know, Nobel Prize-winning economists say that what we're on the hook for is $200 trillion. Our cash deficit is $17.3 trillion, and you know it's a big number. 1.3 is $300 billion, 3,000 million. That's 17.3 trillion. What we're on just our cash deficit. It's unbelievable. And this has got to end badly. And let's go to the bond market. Everybody's thinking that, oh, well, the Fed's the masters of the universe and they can tamp all this down. And, you know, the 10-year Treasury got up to 3%, and now it's down to, you know, 2.7 or so, somewhere in that neighborhood. What do you think about the bond market? Is everything fixed? Is the Federal Reserve the masters of the universe?
Not at all. And remember, the only way you can keep interest rates low is by printing more money, buying bonds, right? You're printing money to buy bonds. Ultimately, that's not going to work. So, I mean, if printing money could do all the things we say it can do without creating inflation, well, why the heck don't we just print more? Why don't we print, you know, $200 billion to you know, buy schools, new schools? Why don't we print $500 billion to rebuild the Army? Why don't we just print it we could get rid of taxes. We just print the money instead if it doesn't create inflation. We also know it will create inflation. So the money we're printing to buy bonds to keep the bond market alive ultimately will create inflation. Has the bond market turned though? Yeah, I think it has. And partly because because of the tapering announcement that they might taper last May, bonds shot up, the interest rate shot up, and the bond values dropped. I think that scared people. People had really never priced in risk into bonds before, and now they're pricing in risk, and I don't think that's going to change. It also, of course, coincides with the fact that rates are near zero, and they can't go much lower. So, people will accept very low interest rates if there's no risk. But if there's a risk of a 10-20% loss, as we saw last year, then I think that's it for the bond market. Yeah, we're going to get some rallies like we have now, but I think overall the bond market has turned, and that's turned for good. And ultimately you're going to have inflation, which is really going to be a problem for the bond market.
Oh, what about the stock market? Let's go into that. Everybody's like, woohoo, it's sold off, 7% or so since the first of the year. So it's had its troubles. Some people are saying, well, the Fed's going to, come back out in. Janet Yellen is going to turn around the taper, which, we were $85 billion a month. Now, my sources say it's much higher than that. They're reinvesting it, and one of my sources who has good sources that is in closed door meetings with people at the Fed say it's $125 billion a month. And let's just take their word. $85 billion a month, over $1 trillion. They cut it back to $65 billion. That's supposed to be some. Wow, we're really making headway. That's only $780 billion a year. $65 billion a month to suppress interest rates. How do you price stocks with $780 billion a year going forward here? How do you price your stocks, and what do you think that your prognosis is for the stock market? Has it changed? Stocks the place to be, as Maria Bartiromo said on Bill O'Reilly the other night. So you got to be in this stock market. What do you think?
Well, when did Maria Bartiromo ever say stocks weren't the place to be? I mean, these people have been pushing stocks for a long time, and that's part of the reason stocks go up. I mean, more fundamentally, stocks should reflect earnings. And last year, stocks were up 30%. Earnings were up about 3%. So we're way out of line with corporate reality. We're way out of line with economic reality. But GDP that's growing 2 to 3%, stock going up 30%, they're completely divorced from economics or from corporate realities, corporate earnings. So what's happening is they're sort of feeling that, well, the Fed's got my back. They're printing a lot of money. Some of that money has to go into the stock market. It doesn't have to, but it can. When people sell their bonds to the Fed, they can take that money and put it in stocks, and they do. And so there's been a feeling that, well, the Fed can boost us up. And I'm not saying that can't continue. The Fed could boost you up. I know they're tapering now, and of course, notice the stock market is having problems. But in the end, if the stock market really fell, could the Fed just announce tomorrow that, well, instead of printing 65, we decided it's prudent to print 130 billion this month and next month. So yes, the Fed can pump this up for a while longer, but it's not the basis for long-term economic recovery or long-term stock market recovery. In fact, as I say in my book, it's the basis for a long-term, huge, huge explosion.
Oh, good one. Obviously, there's so much in this new. I mean, it's amazing that these books. You should have titled them differently, because even though this has a lot of your basic information, it's a brand new book. And you go through today's, each investment in today's terms. And one of the ones that you came out with was gold. Now, I know you're a big gold proponent, and you have been in your other books, and the Aftershock Investor, your first best-selling book. You're a big gold proponent. One of the things that the mainstream media is doing with gold is saying that it's a risky investment. It was up at 1900. Look at it. It's down in the 1200s. It's languishing. It fell all the way down below 1200 and then popped back up. And it's really kind of a risky investment. And in your book, you have a whole chapter devoted to gold. What say you about the risky investment in gold and silver?
Well, let's look at gold since 2000, when the internet bubble popped. Or the first of the big bubbles popped. Up 12 years in a row, every single year. That's risky. Can stocks say the same thing? You've got to be kidding. Well, maybe they didn't perform well. Well, gold, even with the 13th year added, where we did fall 30%, that's a big drop. But even if you add the 13th year in, we're still up almost 300% from where we were in 2000. Can we say that about stocks? No way. We're now above where we were in 2000. Now that's on the Dow and the S&P. I might add on NASDAQ, you're actually still significantly below where you were in 2000. So let's kind of put that in perspective. And I might add, when did Maria or anybody else in the mainstream media say that gold was a great investment to be in? I don't remember hearing that either. What you're hearing is a bias, a huge bias, not borne out by the facts. Any investment that can go up 12 years in a row is a pretty solid, good investment. And any investment that up 13 years is up 300% is a pretty good returning investment, certainly compared to stocks or bonds.
Well, let's talk about the bank bail-ins. There was a Harvard professor. He also has a master's at MIT. I mean, this is a smart guy. Actually, I tried to book him, and he got a little skittish and didn't want to come on. But he said, in his article, he took $1 million out of Bank of America. And he took it out of there because he's not really feeling groovy about the banks. What is the specter of another bank failure, a huge one, or a daisy chain of failures, and or bail-ins, where they actually take depositors' money? Can you talk a little bit about that? Is your money safe in the bank?
Well, sure. Short term, it's kind of like your money's safe in the stock market. It's kind of the same reason. As well, theoretically, the stock market will do well because the Fed will support it. And I'm not saying the Fed won't or can't for a while. I'm just saying there will come a point where it can't, and there'll come a point where ultimately, just like the internet bubble where nothing could go wrong because we're having a whole revolution, people start to think differently. It's not in anybody's individual interest or group interest, I shouldn't say it's not anybody's group interest, to have a housing bubble or internet bubble pop, but they do. And the same thing happens with the Fed printing money. They can print money and help bail out stocks. They can print money and help bail out banks. So there's a lot we can do short term, but you're setting up everything on a very, very fragile foundation. And that's the real problem is, yes, could we bail out banks again? Sure. But at some point, what happens is that people lose faith. The Fed even loses a little bit of faith because remember, really in their heart of hearts, they kind of think that they're just doing this short term, right? Training wheels on the bike. Fed's just helping us get going. But even to them, they're starting to see, my God, I mean, we saw the jobs reports the last 2 months. We've seen other indications. Again, if you stimulus adjust the little bit of growth we're getting, you're actually getting negative growth. There is no recovery. The Fed does know this. They just don't talk about it because their job is to be a cheerleader, right? They want to try to make everybody feel good and that their policies are working. Because if those policies don't work, well, what's the Fed going to do? And, what are we going to do? It's a bigger issue. But bottom line is, I think the banks are safe in the sense that the Fed can bail them out, but there will come a point where the Fed can't and won't. And that's when you've got a bigger problem.
Well, it's a kind of a tell to me when a PhD from Harvard in economics says he's taken $1 million out of Bank of America.
Yeah.
And he left $10,000 in.
Insurance. Yeah.
That pretty much speaks volumes, doesn't it? I mean,
yep.
Is this guy saying that your money's really not safe in the bank long term? And he didn't leave the insurance limits. He didn't leave $250.
Right.
He went down to $10,000.
Well,
which I think is pretty much says a lot. I know he doesn't want to cause a panic, and I know he'd get a lot of pushback from the academia community. I'm sure your brother David has gotten some pushback, even though he's been right. And you've gotten pushback from academia saying, "Hey, what are you doing? Shut up."
Although, yeah, right, it's more of that. Is what it is people don't really necessarily, criticize or have questions, but what it is that they aren't very interested. It's sort of like, well, that isn't what I want to hear right now. In fact, when I do talk to mainstream groups, I talk to a group called Wharton Meets Wall Street. It's sponsored by FINRA, the big securities industry group, and these are all mainstream guys. Almost 1,000 people at Wharton, very mainstream school. And I'll give my presentations, and afterwards, people come up and say, "I can't disagree with what you say. I can't say you're wrong, but I sure hope you're wrong because it's a problem for us." And for a lot of these guys, what they also say is that their companies aren't going to let them do anything terribly differently. In other words, they kind of need to go a certain line. Fundamentally, if you think about it, the whole brokerage industry is, well, brokers. What are brokers but salesmen? Brokerage industry are stock and bond salesmen. They need to sell their product. If I was running a brokerage firm and somebody was out downplaying my product, I'd fire them. That's simple. So, they're under a little bit of pressure. And what I've really found is it's something they just don't like to talk about, not something they tend to refute or argue about a lot. Because the more you argue about it, the more it becomes obvious that what I'm saying makes a certain amount of sense. There may be an issue about timing. I'll be the first to admit I can't say this is going to happen in 6 months or necessarily next year. But there's no question there's a fundamental truth to what I'm saying. I haven't really found that academia or industry really necessarily disputes that. It's more they really just don't want to talk about it, because the more you talk about it, the more the issues you have in terms of, making it more real. It becomes obvious that it is the truth.
Well, I'll tell you a subtitle to this Aftershock Investor book, your updated version, and I'm going to hold it up so people can see it. It could have just as well said, Aftershock Investor, crash course, you're staying afloat in a sinking economy, and the next shock is going to be bigger than the last one. I mean, isn't the next shock not going to be an aftershock, like an after tremor, like not as big as isn't the next one going to be the big one?
Well, funny you say that, because actually a working title of the upcoming book is called The Big One. That is essentially what it will be. Aftershocks can be bigger than the earthquakes, but generally they're not. They're smaller. But what I mean bigger is they can do an awful lot of damage. Oftentimes an earthquake, the most damage is caused by the aftershocks. But technically what you're saying makes sense. The big one will be bigger than the aftershock.
I'm listening to what you're saying, and it ain't over.
Yep.
This
no,
book
it's
says
not at all.
It ain't over by a long shot.
We're just pumping up the bubbles, and all that's going to do is just make them a lot worse when they pop. As my brother says, you just put more gunpowder under the house, and that's really all it is. It feels good for a while, but you're not doing anything to fundamentally solve economic problems. From productivity or other issues, it's not working, and fundamentally, it's not going to work long term. It's just going to cause bigger problems. Again, it makes you feel good, kind of like if you lost your job, but you found a big credit card, your lifestyle might not change until that credit card blows up. So you never know you lost a job and that fundamental productivity you have in your personal life. But what the same thing is happening in the U.S. is that we're not focusing as much on productivity. We're focusing a lot on maintaining asset bubbles, and that's a big mistake long term.
Well, now that you've brought up the title of your book, The Big One, I've been telling people, hey, listen, buying gold ain't a trade. Somebody's like, hey, it's going to be $100,000. Yeah, you know what? No. Please don't think that way. This is a survival strategy. We're going to have a paradigm change. Could you please describe to me what it's going to look like, at least a little thumbnail of your upcoming book? What's the big one going to look like coming up?
Well, not to be promoting books, but before the big one comes up, we actually have the third edition of Aftershock. We wrote both the Aftershock and Aftershock Investor. That'll come out in March. The big one probably won't come out until next year. And what that's basically going to do is describe what we call the final sequence of events, because this whole thing is unfolding for us too. And we don't know exactly how people are going to react, markets react, how the Federal Reserve reacts. So what that final book is going to be doing, I should say the big one book, not necessarily the final book, but it's going to talk about what we think is the final sequence and how this whole thing finally kicks off. And in much more detail than what we talk about in Aftershock or Aftershock Investor, partly because we don't know the exact detail. We're getting a much better feel for it now, but we think by next year, when this book comes out in 2015, that we're going to have a pretty good idea, and we're going to be able to kind of lay out that sequence in more detail, which will be very helpful to investors and individuals, and I think will also prove to be pretty prescient in terms of how we're setting it up.
Is there going to be a big paradigm change? Am I wrong when I say that there's going to be a change and your life's never going to be the same after this thing fully percolates and comes to fruition?
Parts of life. I mean, life has changed for us. I mean, since the 90s and 2000s, we have been very focused on massive amount of bubble growth. Right? We've had massive growth in real estate and stocks. That's created that consumer spending bubble I talk about, a private credit bubble, which you're essentially referring to with Bank of America. All these things are in a bubble, and we've never seen those really pop because we've been able to save the big pop in 2008 with the federal government. But, of course, when the federal government pops, they all do. So in that sense, it's a huge paradigm shift. Now, life isn't going to fall apart, but, yeah, something we would never think about before Bank of America really sort of going bankrupt and not being able to be bailed out by the government. These are big, big, big issues. Consumer spending, even now, we used to build 300 million square foot of retail space a year after 2000, between 2000 and 2008. That's a lot. Last year, we only built 40 million. So, is it is a huge shift? But no, but the consumer spending bubble is starting to pop. It goes much more. Banking, the big thing will be the government. I always like to say, people say, is this like a depression? In certain ways, maybe, but it's not as bad. We're a wealthier country. But what was different is we went into the Depression with the governments whose finances were basically rock solid. I mean, there's a reason people rate us as a AAA great, bond. Our U.S. government has generally been, ups and downs, but generally been pretty pretty reasonable, pretty good about handling its finances, and certainly heading into the depression we were. What's different is this time is we're not. We're not at all like we used to be in terms of our ability to handle, the finances of the government. We've never borrowed like this. We've never printed like this. I think before the show, Greg, we were discussing that between 1913, when we started printing money with the Federal Reserve, and 2008, we'd only printed about $800 billion. Last year, as we discussed, we printed more than that. So we've never been as, I don't want to use the terms immoral, but certainly as unsound in our financial management as we have now. And as you mentioned, $700 billion is a lot to borrow this year. Remember, that's 4 times more than we borrowed in 2007. So a lot of problems real fast. We're really changing what used to make America a very, very fundamentally sound, financial government. And that's probably the biggest change of all we're going to see going forward, is that things that we thought would never change, like the government, are about to.
And the one last thing, we covered gold, we covered stocks, we covered bonds, and I just want to cover real estate. And there's a chapter in your updated book, The Aftershock Investor, the updated version, talking about real estate still in a bubble. And most people will be shocked to hear you say, what? Well, in some markets it came off 50%, and there's been a huge repricing in real estate, and we're coming out of this, they keep telling us. And you say?
We are coming up a bit, partly driven again by the Fed. Just like the stock market is recovering because of the Fed, so is the housing market. When the Fed prints money, it not only buys Treasury bonds, it buys mortgage bonds. That's keeping mortgage rates very, very low. So we're certainly getting a rebound, and a lot of investors are coming in. So it's rebounding on the backs of not homeowners or people who are coming out of college and getting houses, but 50% of all home sales are in cash. I don't think that's the kids buying homes with cash coming out of college, right? So you got a little bit of an investment bubble, just like you do in the stock market. It's coming back biggest in the place that hit the hardest, no surprise. But overall, most communities are still down. I mean, overall in the U.S., we're down about 20% from our peak. So don't think we've recovered entirely. And again, my guess is when you got 50% of your homes being bought in cash, that you're opening up a lot of problems. And certainly the low interest rates are not going to last forever. So just like the stock market, can we bubble this up a little more? Yes. But the key word there is we can bubble it up a little more. But ultimately, this isn't going to work long term. The way for house prices to go up is for incomes to go up, for household formation to go up, for new kids to get, new kids out of college to get good paying jobs, not McDonald's. And right now, that's not happening. In fact, right now, household formation is still about half what it was in 2007.
So real estate, in your mind and in this book, still in a bubble?
Still in a bubble and being repumped up. This makes people feel like it never was a bubble. Nothing makes you feel better in a bubble than when the bubble gets pumped up again. But ultimately, that's not going to work forever. And the bubble will simply pop at a bigger level.
Bob Wiedemer has updated, actually, I won't even say updated, his new book. I mean, it's a completely new book. All the chapters are different. Basic premise, but a completely new book. The Aftershock Investor, Bob Wiedemer. Thank you so much for joining us today on USA Watchdog.
Thank you, Greg.